everyone, and welcome to The Explainer. Today, we're tackling a word that, for better or for worse, shapes some of the biggest decisions we ever make. That word is debt.
So let me start by asking you a question. Think about those huge life milestones: buying a house, getting a new car, maybe paying for a college degree. What's the one thing that makes all of that possible for most of us?
You got it. For most people, the answer is debt. Now, I know it's a word that can feel pretty heavy, maybe even a little scary, but today we're going to pull back the curtain and make it all make sense.
All right, let's start with the absolute basics. What even is debt when you strip away all the complicated financial jargon? Well, at its heart, it's actually a really simple promise. One person, the lender, gives you money, and you, the borrower, promise to pay it back. Simple enough, right? Of course, there's a little catch. You almost always have to pay back a little extra on top. And that extra bit, that's what we call interest. Now, not all debt is created equal. It really boils down to two main types. On one side, you have secured debt. Think of it as debt with a safety net for the lender. It's tied to something valuable, like your house or your car. That's called collateral. If you can't pay, the lender can take that asset. Then on the flip side, you have unsecured debt. This isn't backed by anything physical. It's based purely on your financial reputation, your creditworthiness. It's basically the lender trusting that you're good for the money. And this is where things like credit cards and student loans fit in.
Okay, so we know what it is, but how does a loan actually work in the real world? Let's get into the mechanics of it.
It's really a three-step process. First, you get the money to need up front. That big chunk of cash is called the principal. Then, step two, you start making regular payments, usually every month. And here's the most important part, step three. Every single payment you make is split into two jobs. Part of it pays down that original amount you borrowed, and the other part pays for that month's interest.
You know, this is the perfect way to think about interest. It really demystifies it. It's not some weird, complicated fee. It's just the rent you're paying for the privilege of using someone else's money for a while. That's it.
Okay, let's put this into a real-world context that I'm sure a lot of you are familiar with: federal student loans.
So right now, the interest rate on a new federal student loan for an undergrad is 6.53%. Think about what that actually means. For every $100 you borrow for school, another $6.53 in interest can get tacked on over a year. That one little percentage point has a huge impact on what a college education actually ends up costing. It's a perfect example of how interest works in the wild. And of course, it's not just students or home buyers taking on debt. It comes in all shapes and sizes, for regular people and for the biggest companies in the world. On the personal side of things, this list probably looks pretty familiar. You've got your mortgages for homes, auto loans for cars, and student loans for education. Each one is basically a specialized tool designed to help us finance a different stage of our lives. And businesses? Well, they play in a different league. Sure, they get bank loans, but they can also do something really interesting. They can issue bonds. This is kind of like borrowing small amounts of money from thousands of different people all at once. And for really short-term cash needs, they have something called commercial paper, which is basically a corporate IOU. So, this all leads to the million-dollar question. Is debt a helpful tool that helps us build our lives, or is it a dangerous trap? The real answer is, well, it can be both. You can really see the two sides of the coin here. On one hand, debt is amazing. It lets you buy a home years before you could save up for it. It lets businesses grow and hire people. But there's always a but. The risk is real. If you take on too much, it can become a crushing weight. And high interest rates can make you feel like you're just running on a treadmill, going nowhere. So if debt is this powerful thing we have to handle with care, how do we make sure we're the ones in control? Let's get into some strategies. All right, one of the single most important numbers you need to know, especially when it comes to credit cards, is your credit utilization ratio. That sounds fancy, but all it means is how much of your available credit are you actually using? So what's a good number? Well, lenders really like to see that ratio stay below 30%. So if you have a $10,000 credit limit across all your cards, you want to try to keep your total balance under $3,000. Why? Because it shows them you're not maxed out, that you're using credit responsibly, which makes you look like a much safer bet. But look what happens when that number starts creeping up. Once you go past 50%, lenders start to get a little nervous. A high ratio sends up a red flag that you might be relying too much on borrowed money to get by, and that can really hurt your credit score, making you look like a riskier borrower.
Okay, so what if you want to get ahead and pay your debt down faster? Here are 3 fantastic strategies. First, and this is a big one, always try to pay more than the minimum payment. Second, focus your extra money on the debt with the highest interest rate. That's called the avalanche method, and it will save you the most money over time. And third, you could look into consolidating your debts, which basically means rolling them all into one new loan, hopefully with a much lower interest rate.
So, when you boil it all down, what's the big takeaway here? It's that debt isn't some evil thing. It's actually a fundamental, essential part of our economy. It's the engine that powers so much growth and creates so many opportunities.
So in the end, the real question isn't about whether debt is good or bad. It's about how you choose to use it. Knowing the rules of the game is the first step to making sure it works for you, and not the other way around. So I'll leave you with this to think about. Debt is a powerful tool. Are you its master, or is it yours?